Welcome to the Deep Dive. Today, we're looking at Quest Diagnostics and their first quarter for 2025.
Yeah, they just had their earnings call.
And it looks like, well, a pretty strong start to the year, wouldn't you say? They had some solid revenue growth.
Definitely. The headline number is about 12% revenue growth overall.
12%, okay.
Yeah, and importantly, nearly 2.5% of that was organic growth.
Right, so growth from their core business, not just buying companies.
Exactly. Though acquisitions certainly played a big role too, along with winning some large enterprise accounts, growth in advanced diagnostics, and getting better access through health plans.
And they stuck with their full year guidance.
They did. Reaffirmed both revenue and adjusted EPS for 2025.
Yep.
So seems like they're feeling pretty confident about keeping this momentum going.
Okay, let's dig into that revenue number a bit more. 12% is big, but where is it actually coming from?
Sure. So consolidated revenues, the total figure, was $2.65 billion. That's the 12.1% increase year over year. And their main business, Diagnostic Information Services, that grew even a bit faster, 12.7%.
And what about the actual number of tests they ran? Volume?
Right, volume. Measured by requisitions, that went up 12.4%. So pretty much in line with revenue.
But you mentioned organic growth was lower. How does that square with volume?
Good point. So organic volume, if you strip out the acquisitions, was actually down slightly by 0.9%.
Okay, so overall volume up because of acquisitions, but core volume dipped a tiny bit. Why?
Well, they mentioned a couple of things. Weather had a negative impact, and there was one less day in the quarter compared to last year.
The calendar effect.
Exactly. Those two things together apparently shaved off about 160 basis points, or 1.6%, from volume growth.
Okay, that helps explain the slight organic dip. So if organic volume was down slightly, how did organic revenue grow by that 2.5% you mentioned?
It comes down to revenue per requisition or revenue per test. Overall, it was up just 0.3%.
Okay.
But organically, revenue per rec jumped 3.6%.
So they're getting more money for each test within their core business. Is that higher prices?
Not really, interestingly. They said unit price reimbursement was basically flat.
Yeah, better mix.
Exactly. It suggests they're doing more complex, higher value tests within their organic base. You know, the advanced diagnostic stuff.
Makes sense. What about the different places they get business from, like doctors' offices versus hospitals?
Yeah, so the physician channel saw really strong growth overall, high teens.
Wow.
And even organically, it was mid-single digits. So definitely growing there.
And hospitals?
Hospital channel growth was mainly driven by what they call collaborative lab solutions.
Right, we hear that term a lot. What is that, practically speaking?
Basically, Quest partnering with hospitals. Hospitals might outsource some or all of their lab work to Quest. Maybe Quest manages the hospital lab or handles the more specialized tests.
So it helps hospitals maybe cut costs or complexity?
Yeah, precisely. Avoids big capital investments in equipment, staffing issues. Quest takes that on, gets the volume, and expands its footprint inside the hospital system.
Got it. So moving beyond the pure financials, what were the big strategic moves they talked about? Where's the focus for growth?
There were quite a few significant things, actually. One big one. They were named a preferred lab network for Optum Health.
Optum. That's huge, isn't it? Part of United Health Group.
Exactly. Gives them access to, I think they said, over 85,000 physicians. That's a major channel opening up.
Definitely a big win. What else?
They also announced a deal with Fresenius Medical Care.
The dialysis company.
Yep. Quest will provide lab testing for their dialysis centers, apparently over 200,000 patients there. And they're also buying some lab assets from Fresenius as part of that deal.
So more partnerships, expanding reach.
Clearly a key part of the strategy.
Yeah.
But they're also focused on the consumer side, too.
Yeah, the direct-to-consumer testing, like Quest.com.
Right. They mentioned enhancing the online shopping experience there, adding 10 new tests. And importantly, they said they saw an uptick in first-time orders.
So that direct channel is growing.
Seems like it. And they also highlighted double-digit growth in some of those advanced diagnostic areas that often interest consumers directly.
Like what?
Things like advanced cardio-metabolic tests, autoimmune, brain health, especially their AD, detect blood tests for Alzheimer's risk.
Right.
And also women's health, like prenatal genetic testing, hereditary cancer tests, and even self-collect HPV screening.
So a broad push on multiple fronts there. What about cancer diagnostics specifically? Any updates on newer tests?
Yeah, they started getting commercial orders for their Haystack MRD test.
MRD, minimal residual disease.
Yeah.
Cancer recurrence.
That's the one. Moving it to commercial orders is a big step. They're also working on getting it integrated into electronic medical records, like Epic's Aura system. Make it easier for doctors to use.
Integration is key for adoption, I imagine.
Absolutely. Oh, and randomly, they mentioned an uptick in measles testing because of the recent outbreaks.
Yeah.
Shows how they respond to public health needs, too.
Always something, isn't there? Okay, so growth initiatives, partnerships. Are they also working on just running the business more efficiently? Cost savings?
Yes, definitely. They talked about their ongoing invigorate program. That aims for about 3% annual cost savings and productivity gains.
Wow.
Mostly through automation and using AI in their operations. They also have Project Novia, which is about modernizing their whole order-to-cash process, basically making everything from test order to payment smoother and more efficient.
Streamlining the back office.
And related to that, they announced a new collaboration with Google Cloud.
Oh, interesting. For what?
Sounds like a few things. Streamlining data management, using Gen AI for maybe more personalized customer and employee experiences.
AI is everywhere now.
It seems so. The goal is better data analytics, better tools for doctors and patients eventually, improving efficiency overall.
Okay, lots happening strategically. Let's circle back to the numbers for Q1. We talked revenue. What about profitability?
Right, so reported operating income was $346 million. That's 13% of revenue, up from $300 million or 12.7% last year.
Okay, margin improving slightly there.
And adjusted operating income, which smooths out some items, was $406 million or 15.3% of revenue. That's up from $349 million or 14.8% last year. So a healthier jump in the adjusted margin.
Good to see. And bottom line, earnings per share.
Reported EPS was 184 cents, up from $1.72. Adjusted EPS came in at $2.21, which was up from $2.04 a year ago.
Solid growth there too. And cash flow.
Cash from operations was a strong $314 million. That's a big increase from $154 million in Q1 last year.
Yep, held firm. They're still expecting revenue between $10.7 million and $10.85 billion. That implies roughly 3% organic growth for the full year.
Got it.
Reported EPS guidance is $8.62 to $8.87. Adjusted EPS between $9.55 and $9.80.
Any changes to other parts of the outlook? One notable tweak. They actually increased their operating cash flow expectation for the year to around $1.5 billion.
Oh, why was that?
They mentioned getting a payroll tax credit that boosted the cash flow outlook.
Oh.
Capital spending still expected around $500 million. They still expect operating margin to expand for the full year. Net interest expense around $275 million. Tax rate about 25% adjusted. And share count around 114 million. Pretty detailed guidance.
It is. Provides a good framework. Now, the Q&A session with analysts often surfaces interesting details. Anything stand out there?
Yeah, a few things. On organic volume trends, they basically said expect something similar to the back half of last year, but they did see a rebound late in March that carried into April.
Maybe a positive sign for Q2.
Could be. They also addressed the tariff question, supplies from China.
Right, that's always a concern.
Their message was direct exposure is minimal, less than 1% of their roughly $2 billion spend on regions and supplies. Plus, they're working on diversifying sourcing. And they emphasize that most key regions are made in the U.S. anyway, and many supply deals are long-term contracts. So they feel it's manageable within the current guidance.
That sounds relatively contained then. What else came up? There was a mention of a strike.
Yes, at LifeLabs in British Columbia. That's the company they acquired. About 1,200 employees involved, impacting some patient service centers.
Is that significant?
Management said they're backfilling positions, a mediator is involved, and they hope for a resolution in the next month or a month and a half. They don't expect it to have a major impact on LifeLabs' overall contribution to Quest's results.
Okay, something to watch, but maybe not a huge financial hit right now. Anything on the expected pattern for the year?
Just that Q2 is usually their strongest quarter for EPS, and they expect typical seasonality overall. They also reiterated that LifeLabs is on track to reach Quest's average corporate margin within 2 to 3 years.
That integration timeline is important.
Definitely. And on the hospital partnership side, the collaborative lab services, they said the pipeline looks robust.
More deals potentially coming.
Sounds like it. And they even floated the idea that if suppliers raise prices on hospitals due to tariffs, it might actually push more hospitals towards Quest solutions faster to save money.
An interesting dynamic. What about getting paid for those newer tests, like the Haystack MRD tests?
They've started submitting for reimbursement, talking to payers about codes and coverage. It's a process. They're also focused on generating more clinical data to support it.
Standard playbook for new diagnostics. And the Google Cloud deal. More detail.
The focus seems to be internal efficiency, first, better data analytics, better tools for their own people. Longer term, the ambition is maybe AI-powered services for doctors and patients, but sounds like it's early stages.
Okay. And any regulatory updates? Always crucial in healthcare.
Yeah, they sounded pleased about the recent court decision on LDT's laboratory-developed tests. That clarifies things.
So less regulatory uncertainty there.
For now, it seems. Their main focus shifts to pay-may reform now. That's the Protecting Access to Medicare Act, which dictates Medicare lab reimbursement rates.
Always a big topic. What's the outlook there?
They mentioned seeing bipartisan support for getting something done this year, so cautious optimism, maybe. They also watch the ACA exchanges, seems stable for now, and Medicaid, which is about 8% of their business.
So keeping a close eye on Washington, basically.
Always have to. One final point from the Q&A was about recession risk.
Right. Is diagnostic testing recession-proof?
Not entirely, they admitted, but they argued it's pretty resilient. Testing is essential, and things like the ACA provide a safety net that wasn't there in past downturns.
So maybe less impact than some other sectors?
That's the idea. They said patient collections held up okay during the last big recession. Oh, and they clarified the Q1 volume impacts. Yep. Weather was about a 0.5% drag year over year, but the leap year added 1.1%, so the net calendar weather effect was actually a negative 0.6%.
Good clarification. And one last thing, LDTs again. With the FDA rule vacated, are they still investing there?
Yes, but less than the $10 million they initially thought. It'll focus on supporting areas like companion diagnostics, their life sciences business, and international needs. They also expect wage inflation around 3–4%, but hope the invigorate program offsets that, and they're targeting SG&A leverage. Employee retention is apparently improving too.
Okay, that covers a lot of ground. It really sounds like a solid quarter with a clear strategy playing out.
Yeah, the combination of acquisitions, organic growth in key areas, partnerships, and efficiency drives seems to be working for them right now.
All right, let's shift gears then. Time for our This Is Not Financial Advice segment. We look at the situation, then brainstorm some. Let's call them creative, maybe outrageous but plausible trade ideas. What comes to mind for Quest?
Okay, outrageous but plausible. Let's think. Quest is leaning heavily into consumer-initiated testing, right? Enhancing Quest.com, adding tests.
Yeah, we covered that, trying to get that direct relationship.
And they've got that big Google Cloud partnership aimed partly at improving customer experience, maybe using AI down the line.
Okay, connecting the dots.
So here's idea number one. Go long Quest Diagnostics, betting on this consumer digital strategy really taking off. Pair that with a short position on a competitor, maybe one that's much more reliant on traditional physical patient service centers, and it's been slower to build out a slick digital front end for consumers.
So betting on the digital shift in diagnostics.
Exactly. The thesis is that the convenience and growing range of tests available directly online via Quest will pull market share from less digitally savvy players, especially for routine or wellness-focused testing. It's a bet on changing consumer behavior.
Interesting angle. Got another one.
All right, idea number two. This one focuses on the advanced diagnostic side, specifically cancer.
Like the Haystack MRD test.
Precisely. They're getting early commercial orders, integrating it into EMRs. This whole area of minimal residual disease testing, finding cancer recurrence early, is a huge potential growth area.
Makes sense. So the trade.
Long Quest again, based on the potential for Haystack and other advanced cancer diagnostics to become standard of care. And for the other side, short a biotech company that's maybe heavily reliant on a specific later stage cancer therapy.
Okay. Why that specific short?
The thinking is, if MRD testing gets really good and widely adopted, it could lead to earlier interventions, potentially changing treatment protocols. Maybe it identifies recurrence so early that existing therapies become less relevant, or it enables switching therapies sooner, impacting the market size or duration of treatment for certain drugs.
So diagnostics disrupting therapeutics.
In a way, yeah. Better, earlier information from diagnostics like Quest's could shift the landscape for treatment companies. It's definitely playing the long game and relies on MRD adoption, but it's plausible, right?
It's certainly outrageous, but plausible, fits the bill, definitely food for thought.
That's the idea.
All right, that brings us to the end of our deep dive into Quest Diagnostics' first quarter 2025 earnings. We hit the key results, the strategic plays, and even a couple of wild trade ideas.
A lot going on there.
Indeed. Now, remember everyone, what we've discussed is purely for informational purposes. It is absolutely not financial advice. Please always do your own research before making any investment decision.
Definitely. Do your homework.
So what are your thoughts on Quest's strategy? Do you think these partnerships and tech investments will pay off? Let us know what you think. Thanks for tuning in to The Deep Dive.